Hi friends, Simit here from InformedTrades.com. In today's video, we're going to talk about the payout ratio, what that is, and how income investors can use it as part of their strategy. Let's get started. Okay, key points. Dividend payout ratio is a measure of dividends related to earnings. Payout ratio is on a declining trend, meaning the numbers have been getting smaller over the past decades. Common rule, you want to make sure the ratio is below 100%. A modified calculation is to add share buybacks, and we'll talk about why that is and the sort of the idea you're trying to get at with payout ratio and why adding share buybacks may be an appropriate thing in light of the rise of share buybacks and decline in dividend payouts. And then we'll look at a sample usage with a screener. Okay, so what is payout ratio? As noted, it's a measurement of dividends related to annual income. The basic idea you're trying to get here is how much a company is paying out to shareholders, how much dividends are going out relative to its annual income. So does the company have the ability to pay out these dividends? How taxing our dividends are relative to its income. There's also the assumption that if a company is holding on to its income, that it believes there's a lot of growth opportunity. And we'll get into, that's where buybacks come in, and that might not always be the case. But that's sort of the basic idea. So a high payout ratio may suggest that the company is stable and doesn't see, or is fully mature and doesn't see much in the form of growth opportunities, reinvestment opportunities, so it's just giving its earnings back to shareholders. If that number gets really high, though, it may be a cause for concern. As noted, the trend is declining. You can see on this chart here from the Motley Fool, going back almost 100 years, about 90 years, you see the trend is generally down. We did have a big spike in the 2008 financial crisis. That was where that had more to do with earnings suddenly falling and dividend policy remaining roughly the same. Dividend policy tends to take a little bit longer to adjust often. So that seemed to be what happened there. But the downward trend, and you could, for those who have watched our technical analysis videos, you can see there's maybe something resembling a channel here. We're seeing a pattern of lower lows. The trend in payout ratio is going down. That may be resulting from, low interest rates, so companies think that they can easily invest and get a few percentage points. Why pay that back to shareholders? It also has a lot to do with taxes, where that capital gets taxed if they give it back to shareholders. So they'd rather hold on to it, see what else they can do, send it offshore, things like that. Okay, if a payout ratio is greater than 100%, that might signal some trouble. And that should make intuitive sense. That means a company is paying out in dividends more than its income is. So it's going to have to get that money from somewhere, whether it's existing cash, whether it's taking on debt. But generally, the idea is that if payout ratio is over 100%, it's a bit unsustainable, unless they plan on taking on a lot of debt or if they have a huge supply of cash. But even then, how long can all that really go? It's a warning sign at the very least. On the screen right now, you're seeing a chart of WWE, publicly traded company. What you're seeing on the chart is the dividend per share, and you see it was much higher, and then all of a sudden, in mid-2011, it got cut. Now, the payout ratio for when the dividends were much higher was 182%. So they were paying out almost double the amount of their annual income. That was unsustainable. Then in mid-2011, they had to cut their dividend pretty substantially from 36 cents per share to 12 cents per share. Now imagine you're an investor in this. You bought a bunch of shares. Maybe you're thinking long-term. You're thinking income investment. This could be an issue. It could really, it's not the kind of cut you're looking for. If you had bought with the assumption that the yield was, going to be 4% or 5%, and it might continue growing, now those calculations are way off, and your yield is going to be considerably less. So that's something to think about. Definitely something that worth paying attention to when you're looking at selecting dividend stocks, especially if you plan on holding them for a long time and reinvesting dividends. You want to make sure that income stream's going to be stable. That way you can get the most out of your compounding efforts. Okay, we alluded to this earlier, but share buybacks are basically when a company uses its own capital to buy its own shares on the market. So the result is that it's reducing the amount of shares outstanding on the market. This is sometimes controversial. in that, often what companies end up doing is they'll buy back shares and then they'll issue those shares as stock options or through stock options to their own employees. So one can interpret it as a way of, taking value from shareholders and giving it to management. That's one skeptical view. On the flip side, share buybacks do generally result in a boost in share price, at least in the short term. The idea is that, by reducing the amount of supply out there for shares, you're sort of going to be increasing the basic supply and demand. You're going to be increasing, or that's a factor that suggests price could move higher. And we have seen a trend where companies that are buying back shares are also seeing a higher share price. We'll do a video on that, discuss that a little bit more in detail subsequently. But the basic idea here is that, if a company's, because the payout ratio is declining, you should also factor in how much they're spending on buybacks. And if buybacks and annual dividends is too high relative to their net income, then you might have a problem. So a modified calculation of the payout ratio, or it's sometimes called the adjusted payout ratio, is to look at how much a company is spending on buybacks in a year, what's their annual dividend, and divide that by their annual net income. If that number is over 1, if it's over 100%, or if it's too high, you might say 90, 80, it suggests problems, it suggests limited ability to increase dividend, and potentially they may have to decrease their dividend. Okay, now let's look at a sample usage of a screener. GuruFocus.com is a screener I use, a premium screener. Some of these metrics, you might be able to get on free screeners. GuruFocus has a whole bunch of metrics that I really like, so that's a screener I rely on. And what I've set up now here is a sample of, let's say I'm looking at a stock with a yield of 5%, a dividend growth rate of 5% annually, and let's say we want to look at it and say its minimum years of dividend increases are 2. So it's been increasing dividends for at least 2 years at a rate of 5% each year for a yield of 5% at least. That's current yield is at least 5%. Now here we see, we have 61 total stocks that we can choose from that meet these criteria in the U.S. I'm only looking at U.S. listed stocks. Now if we say that we don't want the payout ratio to be greater than 0.7, for instance, the idea is that this gives us a little bit of room. We want to make sure it's not paying out too much in dividends, that the dividend can be preserved and possibly increased. That reduces it down to 13. So you can see pretty substantial, even if you want to say 0.9, it still took us from 61 to 23. So there are a fair amount of stocks out there that have a high dividend payout ratio, and this can be an important criteria, especially if you plan on holding onto your stocks for a long time. You really want to invest in a stable and develop a stable potential income stream. That's about it. Any questions you have, anything you want to add, join us at informedtrades.com. Help us out, make a donation, contribution at informedtrades.com/donate. Also, if you like our video on YouTube, share it on Facebook, Google+. That helps us out a lot as well. Best of luck in your trading and investing, and we'll see you next time.